You got to own stuff, right? Because if you don't hitch yourself to stuff that inflates in price, you're going to be the loser. Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. Today, before we begin, I want to remind you there's a website associated with this podcast, wealthformula.com. That's where you go if you want to partake in some of the additional resources of Wealth Formula, including some of the things to sign up for. For example, if you're an accredited investor and you're interested in potentially seeing the deal flow that comes through that is limited to investors only, you could go to wealthformula.com and sign up for the Accredited Investor Club, aka Investor Club, and also other sorts of resources there as well. Now, today, what we're going to talk a little bit about is why the rich don't hoard cash. Now, listen, there's no shortage of doom and gloom in the podcast world, as you know, especially in that gold and silver crowd. You know, the ones who spend half their airtime warning you that the dollar is about to collapse, the grid's going to go down, that silver coins are the only thing that are going to save you, except for maybe some gold. I used to buy into that narrative too. I would say that I was a card-carrying member of the zombie apocalypse school of personal finance. I even listened to Peter Schiff religiously, as he is sort of the leader in that cult. But as time's passed, I realized that zombies would not rule the world anytime soon, and I actually became a bit of an optimist. I believe, indeed, in the resilience of the U.S. economy. I don't think society is going to crumble, and I'm not a prepper, okay? That said, there is one warning from the doom and gloom crowd that I think is absolutely true, and it's not a matter of opinion. It's just a fact that the U.S. dollar is indeed losing value, and it's losing value fast. And that might not feel dramatic because, well, gosh, things go slowly. And when things move that slowly, you can't tell. Like, anybody with kids knows that the next thing you know, they go from like 2 years old to 12 years old. You're like, wow, how did that happen? Right? That's basically what happens with the dollar losing its value. But what it means is that if you're sitting on a lot of cash, thinking you're being conservative, you're actually guaranteeing yourself a loss. In fact, it is like one of the foolproof number one ways to lose your money. Just have it sit in the bank or, under your mattress, wherever you keep it, and just keep cash. That's why Robert Kiyosaki says savers are losers, right? It's a clever phrase, but it has a lot of real meaning to it. You see, the reason for all of this is inflation. Inflation isn't a glitch in the system. In fact, it's actually the system. It's actually the system. The Fed will tell you it's the system. They have a target of 2% for annual inflation. Now, in a country running record-breaking deficits and drowning in debt, inflation actually is the only viable solution, right? You have to devalue the currency in order to pay your debt. And how do you do that? Well, you print more money. And whether that inflation comes at that, modest 2% that the Fed wants, or it's 7 to 9% like we saw in recent years, the outcome is the same. Your money loses purchasing power. So let's go through some examples because it's pretty dramatic, right? I am a child of the 70s, 1973 to be exact. But say you were born in 1970, $1 back then has the buying power of $8 today. So if your dad tucked away $10,000 in his shoebox thinking he was doing you a favor, that money is now worth a little over $1,200. Even the money you saved in the year 2000, right? Most of us remember 2000 really easy. That's lost half of its value, half. Inflation is the background noise of our economy. It's always there, always working, always eroding. Slowly when things are normal and fast when they're not. So what do? Well, if you're keeping large chunks of money in savings account, paying less than 1% or any percent less than inflation, you're bleeding wealth every single day. It feels safe. It looks safe, right? Because the numbers may not be moving nominally, but it's not safe. It's a bucket with a hole in the bottom, and you don't even notice until it's almost empty. That's why the wealthy don't hoard cash. They own assets. They own assets that inflate with inflation, right? If you can't beat them, join them. They buy things that grow in value as dollars shrink because they understand the system. They don't fight it. They ride it. They ride that system. Of course, we talk a lot about real estate here, so let's go into real estate for a moment because it is one of the best tools in the game when it comes to this. Home prices tend to rise over time. Rents go up. But if you lock in, let's say you lock in a 30-year fixed mortgage, your payment never changes, right? So while the cost of everything else is climbing, your loan stays frozen. Meanwhile, inflation is silently reducing the value of the debt you owe. You're paying back in cheaper dollars every single year. Then you got ownership in productive businesses. It could be your own business. It could be, stocks. I've not traditionally been a huge stock guy, but hey, I don't see a big problem with stocks. Stock prices can swing in the short term, but long term, well, equities and companies with pricing power, meaning that they can actually raise the cost of their goods with inflation, they outpace inflation typically, the value of those companies. And as an owner, you benefit directly. And finally, there's the, scarce assets. I was kind of giving the gold and silver people, a little jab there earlier, but when you get down to it, gold, precious metals, and Bitcoin now in this category, these are assets in a world where, central banks can conjure up trillions out of nowhere. These things hold real value because they are scarce. So this is how the wealthy play the game, right? While most people are watching their savings accounts decay quietly, the wealthy are stacking assets that appreciate. They're playing offense in a very predictable system. So there you have it. Those are kind of the basics, buy things that inflate with inflation. But let me give you one more ninja tip because we do talk a lot about real estate on the show. Let me tell you what, you can actually print your own money using debt. Think about it. Let's say you buy a $250,000 property, again, using that, 30-year fixed mortgage. You put 20% down, so you're financing $200,000, okay? Now, fast forward 3 decades. Now, even if you paid zero principal and still owed $200,000 in nominal terms, you basically eroded the value of the debt, right? With just 3% in annual inflation, the real value of the debt has been cut in half. You're effectively repaying $100,000 in today's dollars. That's how you print your own dollars. And that's not hedging inflation. That's actually kind of weaponizing it. Now, if you take nothing else from this rant, just remember that currency debasement is not theoretical. It is happening in real time. And this week, I'm going to talk to a guy about why all this is happening, why it might happen at a more rapid pace, and what you can potentially do to protect yourself from the ever-shrinking buying power of the U.S. dollar. We'll have that right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in 2 places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Lawrence Lepard, founder of Equity Management Associates and one of the most outspoken voices in the sound money world. After a successful career in growth equity, he saw the writing on the wall and shifted his focus to hard assets, gold, silver, and Bitcoin. He's been on the show once before as the author of The Big Print, a blunt and timely breakdown of what's going on with our monetary system and how to protect your wealth before the next major reset. Lawrence, welcome back.
Really nice to be with you, Buck. I enjoyed our conversation before. Looking forward to it.
Well, let's start, Lawrence, with the big picture. So you've said many times that the current monetary system is broken and headed for a reckoning. So from your perspective, what are the core flaws in the system right now, and how did we get here?
Well, probably the largest and most obvious underlying flaw in the monetary system is the fact the federal government just can't balance its budget. And so they have to take on debt to cover the deficit that they run. And that deficit, well, over the course of the last 20 years, it's gone up and down. More recently, it's gone mostly up. And we just came through a period where, it was reemphasized to everybody just what a problem this is, because as you'll recall, when Trump was first elected, they were talking about DOGE, the Department of Government Efficiency, and cutting expenses and, maybe $2 trillion or $1 trillion. Of course, then Elon got frustrated and left, and the numbers have come down. And, Trump and the Freedom Caucus was saying they were going to try and balance the budget or at least cut expenses. And of course, what we know is that they just passed this big, beautiful bill, which really increases the deficits, and they bumped the debt ceiling up by another $5 trillion. So sadly, what so many of us have seen and been saying, which is to say they just can't stop, kind of seems to be continuing. And, the reason why that, just to close the full circle, the reason why that matters is they do this debt, they issue debt to cover these deficits, and then the debt requires interest payments, and, there's not enough money to make the interest payments. And so they more or less have to print the money, and inflate the money supply to keep the system going. And that's why it's so important to hard assets.
That's an important point, and I think one just, for people out there listening, I think is really critical, because you hear all the time about, okay, we've got a huge amount of debt, we've got deficits, and it's building. High-paid professionals who are focused on being physicians, being lawyers, whatever, they're like, so what? They've been saying this as long as I can remember.
Yeah, well, that's right.
Right?
Well, look, I don't think there's any doubt they can continue to kick the can, and it's possible that the debt burden could become a lot larger without everything blowing up. But one thing that does happen, and we know this very consistently, is that the money growth has to take place or else the system collapses. And so it's stop, go. But, every now and then it runs into a real problem. You get what I call a big print, right? And so in the GFC in 2008, they printed a ton of money. And in COVID in 2020, they printed a ton of money. And now they're printing less because interest rates are higher, although the M2 numbers have started to increase. But, the one thing that, underlying this, everything's okay, it can go on for a long time, is that, yes, it can, but it will be inflationary. It has to be inflationary. And I think if you look at that particular issue, it's gotten much more acute in the last, 5 to 10 years. I mean, throughout much of the decades of the 80s and 90s, inflation was under control or coming down and under control. And, with the COVID example, I think that's where we turned the corner. And since then, inflation has been pretty high. And yeah, they brought it down from 9% to 3%, but their target is 2%. And I don't even think they're telling the truth about the 3%. I mean, my observation from going to the grocery store is that things are going up at more than 3% a year. So
I think a lot of that is probably energy costs coming down.
Yeah, well, that helps, certainly.
Yeah. So, I mean, that's what really your new book, The Big Print, that's what it's kind of about, right? And so,
yeah, I mean, I've tried to explain how we got to where we are right now and why it seems to be getting worse and how investors can protect themselves given those two facts.
But Lawrence, explain this again, going back to this idea that we always hear about. Listen, I remember as a kid hearing Ronald Reagan talk about this when I was like 7 years old,
right?
And wondering what the big deal was. And, fundamentally, like the theoretical idea here makes a lot of sense, right? It's not that I don't understand what the big deal is. And I think people understand that, generally speaking, you have increasing amounts of debt, and we have to continue to cover that debt. And if we don't grow enough and create enough tax revenue, we have to debase our currency. We have to make it worth less, so that effectively we are making the debt worth less.
Correct.
In the process, that it results in inflation. But what is it now? What is it now, or in the next few years, that fundamentally flips the switch? Where we go from, inflation growing at like 3%, 2%, whatever, to what are you predicting? Are you predicting something in the, going back to like 9, 10, 11%?
I mean, we're going to go back to the high, with the 70s, you had waves of inflation where, we had a big wave of inflation with COVID, and then Powell increased rates and slowed the money supply growth. And so the inflation cooled off, and the supply chain issues got taken care of, which were part of the inflation problem. But I think what'll happen is eventually, we're going to be back in a situation where, there's a chart in the book that I think is a very useful chart that shows the rate of growth of the debt and the rate of growth of gross domestic product. And so think about this as like a family. This is like if a family's credit card debt is going up faster than the wage earner's wages or than the income is going up, eventually you get to the point where you can't even make the minimum payments anymore, And so you got to take out more debt just to make the minimum payments. And that's the problem. The underlying problem is the economy is not growing fast enough to support the debt growth. And this is what, most economists refer to as a sovereign debt crisis. And it's happened in other countries around the world. Smaller countries have gone through this. We've never seen the world's largest country with a reserve currency and the biggest military go through it. But guess what? If you behave like all these other countries who misbehave, you spend too much money, you'll end up in the same place with inflation, with a lot of inflation, I guess is the bottom line.
Going back to the bill, the big, beautiful bill, the argument from the Trump administration is that the CBO is not taking under consideration the amount of growth in the economy that will come from the tax cuts and various other stimulation. So what's your thought on that? I mean,
that's not entirely wrong. I mean, Trump is correct about that, they're going to try and decrease regulations. That should help with growth. They're going to, drill like crazy. That should help with energy prices. And what they've done, I mean, they tried the austerity measure with DOGE. It really didn't work. Then they tried we're going to go with enormous tariffs and pay for everything that way. That didn't really work because the stock market fell 15% in 3 days. So they had to back off of that, which is how he got this TACO acronym. Although they're coming back around on that. They haven't totally given up on that idea. And so now what we see is that, yes, I mean, Besant is clearly saying, well, we will grow our way out of this deficit. In other words, if we get high enough growth and high enough productivity through AI and other means, we can solve this problem. And he's right. I mean, he's fundamentally the math, that could theoretically work, but the debt is growing at a very rapid rate. And to get that much growth in the underlying GDP or that much increase in productivity out of AI is extremely unrealistic.
How much would we need, Lawrence?
Oh, a lot. I mean, we need to grow the economy at, 4, 5, 6, 7% a year, which we've never really done on real terms.
Well, I think that is kind of what they're projecting, right? I mean, that is kind of what
it might be, but it's going to be harder than hell to achieve. I mean, you can't just snap your fingers and create that growth. Now, don't get me wrong. If you ramp up inflation, if you have 10% inflation, well, then the GDP number is going to get bigger fast. And so really the model they've used, they call it the R-star model, is that they've got to have faster growth. The growth rate has to be higher than interest rates, or else you're in a debt spiral. And so what's been happening is, by the way, that's why Trump wants to take interest rates down so much. He's called for a 300 basis point cut. I mean, imagine right now with inflation running at 3+%, if they cut rates to 1.5% or 1.25%. I mean, it would be good for the economy. People would refi their houses. There'd be all kinds of, growth.
right.
But
Huge.
in turn, it would be inflationary, very inflationary. That's the trap they're really kind of caught in. It's a 70s kind of stagflation sort of environment. If they don't keep rates low, they're not going to have any growth. If they want to get growth, they've got to keep rates low. But that's going to lead to monetary creation, which is going to lead to inflation. Look, how it all resolves is very complicated, and none of us know.
Yeah, sure.
But what I do know with very high certainty, with a lot of confidence, is this is going to be an inflationary decade. It's already been an inflationary decade, and because of the way the math is today, it's very highly likely to continue to be an inflationary decade until we fix this monetary system.
You have warned about what you call crack-up boom. What is that?
So Ludwig von Mises created this term in the Austrian School of Economics. A crack-up boom is when there's so much money going into the system that the price of absolutely everything rises, and it rises really quickly. And this is kind of the extreme version of what Trump is trying to do. The good news is stock prices go up, wages go up, salaries go up, GDP goes up, that goes up too, hopefully slower than the other items. And it's really the process of currency failure is leading to the price of everything going up. The fact that the price of your food and your cars are going up isn't because you've got better food or better cars. It's because there's more money out there chasing, the existing food and cars. And so, that's what's really going on, that we've got, I think we've got the potential for a crack-up boom to occur. I mean, let's look at a couple of examples. When, Venezuela is a recent example of hyperinflation, and Weimar Germany back in the 1920s was another example of hyperinflation. In both of those cases, their stock markets did extremely well. And so what's very interesting now, if you look at kind of a survey of what's going on in financial markets, these are the markets I look at every day. I look at the price of gold, look at the price of silver, I look at the price of Bitcoin, I look at the price of the stock market, and I look at interest rates. And, the stock market is at or near record highs. Gold, silver, and Bitcoin are at or near, silver's not quite there, they're getting there fast, at or near record highs. And I also look at the bond market. The bond market's not doing particularly well. It's not at record highs. I mean, interest rates have been, particularly on the U.S. 30-year, they've been going up.
Mhm.
And that's because I think the bond market smells what I'm describing, which is inflation, and bonds perform very poorly if we have inflation.
That has been sort of the saving grace of the U.S. Economy, the biggest economy, the most reliable economy in the world, that our bond market, it's like, okay, well, so what else are they going to buy, right?
Well,
Like
that's true. That's true. But, if you look at all the big countries that own our bonds, they've been slowly but surely moving away from them. Now, they're not going to dump them because they recognize that would throw the world into a tizzy. But,
what are they buying then, Larry?
well, they're buying stocks, or they're buying gold. I mean, if you look at the gold ETF growth in Asia, it's really stunning. I mean, China and, people in Asia are buying a lot of gold. And so I think what's going on is, historically, looking backwards the last 4 years, the U.S. Treasury bond was the most secure, most stable, best, store of value, long-term asset. I mean, it just was. And I think that's changing. And it's changing for a lot of reasons. It's changing because we grabbed the Russian reserves. It's changing because of how fiscally irresponsible we've been. Changing because more and more people are seeing that the dollar is being diluted very heavily. And so they're saying, you've now got people like Russians and Chinese, say they trade with each other, or say, take the Saudis and the Chinese. Say the Saudis are selling, oil to the Chinese and they receive Chinese yuan. And so the Saudis now have their, the yuan, and they might say, okay, well, China makes some machine tools that we want. Fine, they'll buy it. But they've got more yuan than they need. They don't have things to buy. Well, instead of in the past, what they might have done was converted that yuan into treasury bonds and held it there. Now what they're doing is they're converting it into gold. And they're doing that because they recognize that gold can't be printed. And the system as it's currently constructed is very highly likely to lead to a lot more monetary printing.
So there's a historical link between war and inflation. And when I start hearing about some of these things that you're talking about, it makes me think, well, yeah, but how long is that going to go on? How long is the U.S. going to allow these kinds of things to relegate the dollar? So with these geopolitical tensions, military budgets exploding, how do you see the feeding into the monetary debasement story?
Yeah, that's a great question, and it's complicated because it actually maybe is good for the world, is that the United States has offshored so much of its manufacturing capability to China, and China has such a stranglehold on these rare earth metals, which are used heavily in the defense business, that we almost couldn't fight a war with China because they're one of our suppliers for the weapons we'd need to fight one.
And they need us too.
Well,
Right?
and they need us too. That's right, because they sell a lot of things. Although it's interesting, they needed us a lot more 5 or 10 years ago before their own consumer market had developed. There was a great chart I saw recently that showed that they're actually selling more automobiles in China than we sell in the United States. And, so they've developed, and the United States exports as a percent of all Chinese exports, it's down in the teens, whereas I think probably 5 or 10 years ago it was a much higher number. So we like to think, well, they need to sell into our market. So, they've got to behave. Well, yes and no. I mean, that's slipping over time. The balance of power all around the world is changing. And, it used to be just kind of a one-way balance of power. The U.S. was the hegemon and everyone else had to eat the scraps. And that's kind of shifting, and it's not as if the U.S. is going to fall to the bottom. It's just that they're going to be different blocks, and each block is going to have a certain amount of power. And having the U.S. dollar as the world's reserve currency, the strongest currency in the world, the treasury bond is the base level. That was an enormous privilege that allowed Americans to live better than most of the world for the last 10 or 20 years. I mean, I remember very clearly traveling all over the world throughout my career and my life and thinking the average American just lives better than the average person overseas. And that's really the reason why, is because the dollar was the reserve currency and we could live beyond our means.
So you really think we're going to lose reserve status here, though?
I do. I mean, it's not going to zero, but just it's slipping. You know what I mean? I mean, it used to be, the numbers I saw, I think it used to be that, 95% of trade, transactions used to be dollar denominated. I don't know, it was maybe 10 years ago. It's down to like 65 now. So that's slipping, right? So, and the reason for that is just that, people are becoming to recognize that, you can get screwed in the dollar. I mean, let's just look at it from an investment point of view. The dollar this year in 2025 is down 10% from the end of last year. Now, if you're a U.S. or if you're a foreign investor and you bought American stocks, so you took your currency, you bought an American stock, you held it. Let's say it's up a little bit this year, not much, but you now want to sell it and bring your money back. Well, because the dollar is weaker and your currency is stronger, you take a 10% haircut on your loss because you were holding dollar-based assets. So, it becomes a problem. And that, a lot of our stock market is propped up by foreign investors. And as this problem becomes, more and more people become aware of this problem, then I think they're going to, be less inclined to invest in U.S. assets. And then the U.S. stock market falls, and, heaven help us when that happens, because, if you think the federal government's running a big deficit now, imagine what would happen if we had a big market dislocation like we had in 2008 or, in 2000. I mean, in both of those cases, the deficits really blew out. So it's, it's problematic, and you can kind of see the storm clouds on the horizon.
Let's talk about the Fed. Okay.
Yeah.
You've been blunt.
I'm a Fed basher.
In your view, we know what they got wrong before, right? I mean, they waited way too long to raise rates. They potentially could have kept things in much better control.
Especially on the housing stuff. I mean, why they were doing the housing stuff is,
Yeah. And we're feeling that, obviously, in the real estate space. It was a huge shock to the system. It's created significant distress. They're in a tricky place, though. And I guess the question is, what are they getting wrong right now, in your opinion? And is there a path forward that doesn't end in crisis?
Yeah. Look, my view is there shouldn't even be a Fed. Having a cartel set the price of money is just not good, and it's wrong, and it's what's created all these problems. So,
and then you just let the bond markets pretty much dictate everything?
Yeah,
That probably would make sense.
Basically, the interest rate should be freely set by, there are people who save money and buy bonds and lend it out. And then there are people who need to borrow money. And so the supply and demand should set a price. You shouldn't have 12 guys or men and women laying around a table going, oh, money costs this, money costs that, and changing it around so that nobody knows what's coming next.
Well, they do have the power. So what should they do then right now? Because, I mean, obviously they've got pressure from the Trump administration to bring down rates, but that could paradoxically increase bond price,
Yeah, well, look, if they wanted to defend the currency, he should take rates up from here, but he would also create the economy. We'd have a real correction. And to be honest with you, I think the only way out is the inflate your way out route. And so it's going to massively debase the currency, but, that's almost baked in the cake. People think they have a lot of choices, and they really don't. I mean, their mandates are employment and inflation. But really, the third mandate is to keep the financial system running and sound, operating markets. And if they raised rates to try and totally, tame inflation, the whole thing would collapse. And if they lower rates, as they need to do, to get the economy going, get growth going again, and hopefully stoke up another bubble that, has a chance of making the GDP more realistic compared to the debt, then there's going to be inflation. And so, my view is they should do a reset where they say, we've made all these errors. The dollar's overvalued. We're going to reset the dollar to this amount of gold or this amount of Bitcoin and go forth
but that's not going to happen.
Of course it's not. Of course it's not. Yeah.
Yeah.
So, I mean, I think in terms of what will really realistically happen, my sense is that Trump will either be successful in browbeating Powell out of there. They're talking about maybe challenging him on this overrun on the, rehab of the Fed building. I don't know if that's enough to fire him, but there's been a lot of messaging. They might try. But probably more realistically, what's going to happen is his term ends in May of next year. And we have heard a lot of talk about Trump and Bessent or others appointing kind of a shadow Fed president, which is to say they say, we intend to appoint so-and-so to be Fed president in May of 2026. Now, suddenly, people listen to what Jay Powell says, but they also, if you think about how markets are forward thinking and they don't just care about today, they care about where you're going. This new person could say, hey, when I come in May, we're taking rates to zero and we're doing QE. Well, if that's the case, what would happen? The markets would front run it, knowing that's coming. They'd get all bulled up and off they go. So, will that happen? I don't know.
Yeah. And let's talk about how do you react to this? Obviously, when you think about what you said, debasement of the currency is inevitable. And it seems pretty clear from the standpoint of anybody who's a retail person out there, an investor, you got to own stuff, right? Because if you don't hitch yourself to stuff that inflates in price, you're going to be the loser. And so that creates an enormous sort of situation for haves and have-nots in this country too, at the same time, right? Because there's a lot of people who just live paycheck to paycheck.
And they don't have assets. And that's, Buck, that's the real unfairness of the whole system. And I talk about this in my book is that, the big, rich, powerful guys on Wall Street and all the insiders, the hedge funds, they can all borrow at very low rates and then buy assets that yield something greater than those rates. By doing that, they enrich themselves. We, you, me, the average American can't borrow at low rates. If we want to borrow money, it's a credit card, and the credit card's charging you 25%.
Yeah.
So,
although one thing that people can do, we've talked about this, and it's a little slippery slide. You have to be careful with the leverage, but in an environment it's inflationary like this, having debt is printing your own money essentially, right? Like, so if you are taking a mortgage on a rental property or something like that, and you're covering your costs, the actual value of that debt that you have is going down because of inflation as well.
No, that's absolutely right. As long as you don't get yourself too far over your skis and you're very prudent about it, borrowing, the one area where Americans actually can be like the quintillioniaires is they can, particularly when it's cheaper. Remember, I bought a house and I got a 3% mortgage on it and I didn't even need a mortgage, but I thought, well, that's awfully cheap. So there are times when that makes sense to do, but in general, it's hard to get, other than for real estate, it's very hard to get low cost debt.
Right.
If you're a consumer.
Let's talk about non-real estate type things. We talk about a lot of real estate here, but you kind of wear gold, that's kind of what you were, like gold, precious metals. But what I think is fascinating about you, and what I do appreciate about you, is that you've come along to recognize the value of Bitcoin. You've been around the block for a long time, and there's plenty of gold bugs out there.
Yeah, I know. I hate it. Yeah.
And a lot of them are still not buying into the whole Bitcoin thesis. So what got you to believe in Bitcoin? What is it about Bitcoin that you think puts it into the category of precious metals?
Yeah. So I was very fortunate in that I was also, before I got into the sound money trade, I was a technology investor. I was always watching new technologies come along and change the world. The last one I invested in that worked real well is I was early investor in a lot of internet companies in the early 90s. So, if you think about what Bitcoin is, Bitcoin's a new form of money, but really at its core, Bitcoin is actually a technological innovation. The guys, the Satoshis, or Satoshi, if it was one person, what they did was they figured out a way to make something digital scarce, which is kind of counterintuitive. You think about a file, a music file, a sound file, a movie file, a Word doc. Anything that's digital, man, you can make 1 million copies of it. Just press a button, you got 1 million of them, right? And so if it's digital, it can't be scarce, but that's not what this is. They actually created a system through blockchain and electrical use and proof of work to create these digitally scarce tokens, kind of a digital electronic form of gold. And money retains its value because it's scarce. Sand isn't money because there's an infinite amount of sand in the world. And there were other things that have been money, cows and so forth, but even the supply of cows can grow and so forth. And so over time, 5,000 years, humankind kind of figured out, this gold shit is really scarce. There's not a lot of it. And, we only add to it about 1.7% a year to the outstanding stock. And so therefore it makes a really good form of money. If you hold gold over long periods of time, the fiat price might vary, but the amount of things you can buy would be similar. They say, 1 ounce of gold would buy you a toga or a suit back in ancient Rome. It'll still buy you a suit today. So, scarcity was kind of what drove the highest level monetary use. And then, so what these guys did is they developed a means of providing digital scarcity. And they even went one step further than gold, which is they fixed the amount. They fixed the supply at 21 million, which we're not there yet, but we'll get there. So now you've got a digital token of which there are only 21, or there ever will be only 21 million of them. So, and that's really provable and checkable, and you can see it on the blockchain, and it's worked flawlessly for 16 years. Every 10 minutes, a bunch of transactions go through. So that's what's different. And when I saw that, it took me a long time to understand it. And my initial skepticism was, I didn't believe they'd done it, because if you actually go back and look at the history of it, there were a lot of attempts to do it before. There was something called eCash and DigiCash
and Hashcash and all that stuff.
Hashcash and the Chaumian stuff. And I mean, there were a lot of guys who tried to do it and they failed. And if you get to know Bitcoin, which you understand all the intricacies, like the difficulty adjustment and halving mechanism and so forth, you really come to realize that, man, this is whoever built this thing was smart.
Yeah.
This is really quite an innovation. And so in the early days, a lot of us were kind of like, it's an experiment. We're not sure it's going to work. Well, now we're 16 years into it, 900,000 blocks have been processed, flawlessly. And it's kind of like, okay, I kind of think, 16 years of proof. I mean, I kind of think the technology is sound.
Well, what's interesting to me about it is it's 16 years of nonstop growth in terms of people and institutions and governments starting to open up to it, right? It's not stalling. And one thing that I think that I believe is that people look at the price. I mean, last night I think was all time like $122,000, and people look at that price and say, oh, that's really expensive. And frankly, it's funny because I remember looking at it at $22,000 and thinking, I might wait for a dip to buy a little bit more. But now it's $122,000 and the same kind of thing. But this is a expensive, but oddly and paradoxically, in my view, safer asset to buy now than it was when it was 22,000 or 6,000.
Absolutely no doubt. I mean, a lot of, they had the block size wars and they had the hard forks, and a lot of the technological wrinkles have been worked out of it. So
now governments and
well, that's exactly right. I mean, I remember 5 years ago, I said, the government's going to shut this down. Well, no, they're not. There's an ETF. And we've got, the Trump administration talking about a strategic reserve. You're right. So a lot of those risks have disappeared. And back to your comment about the pricing, I think that's always an interesting one to tackle. And that's really, right now, as I try to get people to buy it, that's probably the number one concern. They're like, well, yeah, Larry, but you bought it a lot cheaper. And, I got to pay this high price. And how can I do that when you bought it cheaper? And of course, I felt that way when I was paying, a couple $1,000 and Max Kaiser had bought it at $1. It's kind of like, Max got a lot better deal. Well, so Max was smart and early and he got it ahead of me. I mean, to me, if you think that the fiat currencies are failing, and I kind of do, based on what we described earlier, and this is all in the book, Stein's Law and so forth, and you think that sound money is the solution, which I also do believe, and the two forms of sound money are gold, which is analog, and Bitcoin, which is digital, then these things represent, lifeboats. They represent monetary lifeboats, because ultimately the dollar is not going to buy anything if it fails. Now, that's a long ways away, but it could happen. And so, the way I frame it to people is I say, well, look, yeah, I bought some of my lifeboats at 300. I bought some at 10,000. I bought some at 30,000. And I got these seats in this lifeboat, and now it's 120,000 to you. And you're standing on the deck of the Titanic, which is the US dollar, and you could argue I'm being too dramatic, but do you want to sit in the lifeboat or do you want to stay on the Titanic? And so, yeah, you got to pay a little bit more, but I'm sure, Buck, that in 5 or 10 years, it'll be
$1 million
coin.
It's going to be $1 million, probably 5 years.
Some bigger number. And people will be saying, holy shit, to people who are buying right now, you got one of those for 118,000. Oh my God. Those cost $1.5 million now.
I kind of think about it that way right now, is like people buying right now. If there was anything that you're going to bet that was going to 10x in the next 5 years out of the major assets, and I'm not talking about anything.
I can't think of anything even close.
Not even close.
I mean, maybe gold, if we have a gold reset. The gold's very fully distributed. That's yesterday's technology. It's hard to verify.
Yeah. The other thing is that the generational issue here is a big one, right? Like younger people coming up, they're not buying gold. They're buying Bitcoin, and they may be buying Bitcoin for the same reason that earlier generations bought gold.
Oh, absolutely. It's the exact same reason. Yeah. It's just a better form of gold.
Yeah. But they're not buying gold. They're going to buy Bitcoin. Bitcoin has this sort of,
technology element of it as well. And as you probably know, they've done plenty of surveys on this, and people seem to have a lot more faith in Bitcoin, the younger ones, than they do even the stock market.
Absolutely.
So,
And that's not misplaced. I mean,
yeah.
the nice thing about it is it doesn't have a management team, and it's mathematically driven, it's algorithmically driven, and so it's a trend in motion. I mean, I just don't see what's going to stop it.
Yeah. I mean, people worry a little bit about the supercomputers and that kind of thing.
Yeah, quantum computing is a threat for sure, but I've listened to all the people talk about that. It's way, way out as a threat.
Yeah. Well, the other thing is it's a threat to everything, really. I mean, if you think about, it's going to be a threat to chase Manhattan. It's going to be a
that's
threat
exactly right. There are other places they're going to use it to break code and go steal stuff. So, and there will become, my sense is what I've heard from the people I've spoken to is that if it becomes a serious threat, there'll be in turn a serious solution to it. We'll then create a hard fork, and all the Bitcoin will migrate to that new solution, which is more secure and can't be cracked by quantum. So,
right.
The people who scream about quantum, I mean, I think if you really go and talk to quantum people, they'll tell you they're
so not as worried. Yeah.
Yeah, they're not worried at all.
Yeah. Yeah. It's interesting. Let's make this practical. Someone listening right now worried about all this. I mean, just buy Bitcoin and gold? I know we don't want to give you
I've tried to aim the book at the broad cross-section of Americans and people around the world. They're just trying to protect their family and, protect their savings. I think people have been lulled into 40 years of falling inflation and deflation. And a lot of people make the mistake of thinking, oh, that's going to continue, because it was a 40-year trend. I mean, that's a long time. But, like any trend, it finally met its endpoint when we got to negative interest rates and huge spending and huge deficits. And so now the trend is going in the other direction. And I just think it's very important that all people think about their savings and having them in things the government can't print, which, means real estate, gold, silver, Bitcoin. Government can't print any of that stuff. And the governments are going to be forced into printing because the system as constructed, it's kind of a bribery racket where, in order to get reelected, the officials give shit away, and, they don't have the shit to give away because the tax revenue is not high enough. That's okay. They'll print it. All that's really doing is just watering down the beers. The one that really shocks me, Buck, I'm sure you've seen the same thing. It shocks me every time I go to the grocery store. I just can't believe it. I'm like, because I've been shopping for my family for years. My wife doesn't like to. She gives me a list. I go, I remember what a $20 or $30 or $40 basket of groceries used to look like, and it's multiples of that today.
Yeah, I just look at eggs, right? I've been looking at eggs since I was a little kid.
Any of them. I mean, any of them. It doesn't matter. I mean,
right.
Just go anywhere. I mean, beef, hamburger, all that. I mean, I remember hamburger used to be $1 a pound less. I mean, high quality hamburger with grass fed, whatever. It's $9, $10 a pound. It's nuts.
You just got to own something. You got to own something that is going to appreciate in value and not be fearful and hold on to a bunch of dollars. And I think that's the moral of the story.
The real people that lose in this game are the people who hold bonds and the people whose salaries don't adjust rapidly enough as these prices go up,
Yeah.
And so it's a very pernicious game. It hurts people.
Well, Larry, the book again is The Big Print, and I'm sure it's available anywhere and everywhere.
It is. It's not in bookstores yet. I haven't got a publisher yet. I've self-published it on Amazon.
Okay,
so really,
got it.
If you go to Amazon, you can get it audio, e-Kindle, hardcover, softcover, all that kind of stuff. So,
well, I appreciate the conversation, and we'll love to have you back again.
Sounds great. Thanks, Buck. Nice chatting with you.
You make a lot of money, but are still worried about retirement. Maybe you didn't start earning until your 30s, and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for, and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. And again, I think the moral of the story here is simple, right? If you are sitting on cash because you are afraid to invest, that's probably not wise. That's probably one of the only ways you're going to guarantee loss of buying power of your money. So go buy something. Go buy something of value. I don't mean a depreciating asset, but buy something that is going to inflate, right? That's the game. You got to find the ship that you kind of latch onto and make sure you stay afloat. Anyway, that is it for this week on Wealth Formula Podcast. This is Buck Joffrey signing off.